Section 8.1, Elaboration on Key Fundamentals, Market Structure. First, dissecting three different levels of structure referred to as level 1, 2, and 3 when focusing on a specific price point. So back in the Mentorship 2024, I have already elaborated on our different levels of structure and how you can use them in the most effective way, applying the domino effect. However, I do understand how there might have been some confusion around the concept because the importance of the structure pool is not connected to the time frame that we're pulling it on, but rather the way that we are pulling the structure. So either from bottom to top or top to bottom. And therefore the terminology level 1, 2, and 3, it showcases the different characteristics of each individual market structure pool rather than a time frame. And I was diving deep into my own analysis to look at how I actually use my level 1, 2, and 3 structure pools most of the time. And I came to the realization that I use it in two core ways that can be explained in a very simple but effective manner, which is what we're going to be doing here. And I think it's going to help a lot of you guys understand the concept better. So we have two core main ways. Now, our level 1 market structure is always going to be the most important market structure pool depending on what we are focusing on. And this is very crucial to understand because technically speaking, there are hundreds of different levels of structure on an individual chart, but not every structure pool is as relevant as the other. When we're looking to confirm a 5-minute pivot point, we do not really care what the 2-week time frame is doing. So the level 1 market structure pool is always going to be the most important market structure pool and is going to be depending on what we're going to be focusing on in price. Okay, so right here we can see that level 1 is trending up. We have a low, we have a high, and we have a higher low and a higher high. This could, for example, be the most recent expansion from range discount to the equilibrium of the range, okay? And we can see that level 1 is trending up. That's what we're going to be focusing on. That's our primary focus, and therefore level 1 is the most important market structure pool and is trending up, making a low, a high, a higher low, and a higher high. And the market structure can be drawn from bottom to top. If level 1 is trending up, and the market structure is therefore drawn from top to bottom, level 2 will always be drawn from top to bottom and will be trending down. If our level 1 is trending up and the structure can be pulled from bottom to top, level 2 will always be trending down and the structure will always be pulled from top to bottom, as you can see right here in red. Level 3 will simply be the refined market structure of the most recent expansion of level 2. So you can see that most recent expansion towards the downside of level 2. The refined structure in that leg is going to be our level 3. And we're simply going to using that from a domino perspective. So if we have level 3 right there and we break that back to bullish, that confirms the rotation back up to level 2. And then we break level 2 back to bullish, and that confirms the rotation back up to level 1. But the characteristics is simply if level 1 is trending up, level 2 will always be trending down, and then level 3 will be the refined structure of the most recent expansion of level 2, which we can use from a domino perspective to confirm a very early entry for a higher time frame pivot point. Now this obviously works in the exact same way also when we're trending down. So you can see right here, level 1 has a high, has a low, has a lower high, and a lower low. Therefore, level 1 is trending down, and the structure is drawn from top to bottom, and therefore level 2 will always be drawn from bottom to top, and is trending up right here. And again, level 3 will simply be the refined structure within the most recent expansion of your level 2, which you can see right here in blue. And then we simply use that level 3 from a domino effect perspective, where if we break level 3 back to bearish, that confirms the rotation back down to level 2. And if you break level 2, that confirms rotation back down to level 1. So that's going to be the first core way that we're going to be looking at structure from a level 1, 2, and 3 perspective. If level 1 is trending up, level 2 is trending down, and level 3 is the refined structure of the most recent expansion of level 2. If level 1 is trending down, then level 2 is trending up, and level 3 is the refined structure of the most recent expansion of level 2. The other way is when level 2 has already been broken and we're trying to confirm the pivot point after our level 2 market structure break. So you can see right here, level 1 is trending up, having a low, a high, a higher low, and a higher high, and level 2 is trending down and has already broken structure back to bullish right here. This bullish breaker structure already confirms the rotation back up to that level 1 market structure high. However, now after that bullish breaker structure, we see structure develop from top to bottom, and that is simply going to be our level 3. And if we break that level 3 structure back to bullish, that confirms the rotation back up to level 2, and therefore also the rotation back up to level 1 due to the bullish breaker structure that we already had. So in this case, we're using level 3 to confirm the higher low for the higher high on our level 2, because level 2 already broke back to bullish. And in the first example, we're using level 3 as a refined approach to confirm the rotation back down to level 2. Here we already got the level 2 break, and we're simply confirming the higher low for the higher high of level 2 using level 3. And happens and works in the exact same way when we're trending down. You can see level 1 having a high, having a low, having a lower high for a lower low, and then therefore the structure can be drawn from top to bottom, and level 2 will therefore be drawn from bottom to top in this uptrend. And you can see level 2 already broke structure back to bearish, and we're simply using our level 3 to confirm the pivot point for our lower high for the lower low of level 2. So the moment you follow that structure right there, the moment you follow that structure locally up right there, and you break that level 3 back to bearish, then that confirms the lower high for the lower low on that level 2. And because you had this breaker structure, the rotation and the high time frame order flow objective of coming to that level 1 low has already been put in place. So these are simply going to be the two core main ways that we're going to be looking at structure from a level 1, 2, and 3 perspective. In the first way, we're using level 1 and level 2, where level 1 is trending down, level 2 will be trending up, and level 3 will simply be the refined level of the most recent expansion of level 2. And the other way, level 2 has also already been broken, and we're simply using level 3 to confirm the pivot point of level 2 within a confirmed high time frame order flow objective of already coming back to that high due to the level 2 breaker structure. That's a mouthful, okay? But without making it too complicated in the beginning, I already want to showcase you what I exactly mean with level 1 is going to be the market structure, the most important market structure pool, depending on what you are focusing on. So, need some water for this. If I'm focusing on the uptrend, let's use this as an example right here, this example, okay? Let's make that gray. We're focusing on this situation right here. If I'm focusing on this uptrend as my level 1, then that automatically makes this my level 2 and makes that my level 3. However, if I'm more zoomed in this region right here, and I'm keeping my focus, for example, on this breaker structure right here, and I'm placing my focus on that break, then that is going to be my level 1 breaker structure. And then this downtrend is going to be my level 2 breaker structure. Right there. And maybe after this break, price has some local retracements that also has structure. And that will simply be my level 3. Just like that. So because I'm focusing on this as my level 1, this automatically becomes my level 2, and that becomes my level 3. But if I'm focused in this region right here, then that becomes my level 1, this becomes my level 2, and if I see refined structure right there, that becomes my level 3. It all depends on what you are focusing on and what is relevant to you at that specific point in time. For example, another one, looking at this on the right here, I can use this as context building right here, right? This is going to be my level 1, which is trending down, and therefore this is trending up, okay? Level 1 and level 2. But let's say we break that level 3 structure back to bearish, okay? Then we have the confirmation to get that through rotation back down to this low. However, if I'm looking for some local plays in here, for example, and I'm shifting my focus not to the broader picture, but to the zoomed in picture in this region, then my blue structure, which was initially level 3, if I looked at this as my level 1, level 3 can then become my level 1, because I'm simply focusing on this as my primary focus. And therefore that becomes my level 1 structure pool right there. And then maybe right here we get a retracement, which will then be level 2 right there. So technically speaking, if you look at the entire picture, you could call this 1, you can call that 2, you can call that 3, and this extra could be called 4. But I don't like to do that, because then you have this whole different levels and segments of structure, and you can basically count up to 100, which is just too hard to keep track of. And also it's not necessary to keep track of it, because we're only using the structure that's relevant to us when we're focusing on a specific entry. But I want to highlight that that level 1 simply is the primary focus or the primary structure pool depending on what you are focusing on. So there will be plenty of situations where I'm using this way of my structure to build context on the high time frame, right? I'll look at this 1, 2, and 3 as my high time frame context building. And therefore, because we have like this level 3 breaker structure right here, my high time frame order flow expectations is to come down to here. And I'll simply use that as context building, okay? I'm expecting price to come down to here. So then when we get some sort of a retrace in here, I'm looking for my distribution models in there. However, if we get that distribution model, let's say we do something like this, right? And we get that distribution model, then if we break that range low right there, then that confirms the rotation right there. If we get that breaker structure, then that confirms the rotation back down to this low. And that comes and breaks that low, confirms rotation back down to that low. And then the high time frame order flow objective is in play, right? Technically, you can call that 1, 2, 3, and 4. But there could be even more structure in this region. But for this distribution, all this is not particularly relevant for this exact entry. And I'm simply zooming in into this region, and I'm calling my blue market structure my level 1, and then this will simply be level 2. So I don't want to be too confusing now. I just want to elaborate on the fact that level 1 is simply going to be the structure pool that you're going to be focusing on. The most important structure pool depending on what you're focusing on, okay? And then we're always looking to refine it down or to simplify it back down to 3 different pools, 1, 2, and 3, that all have these characteristics, where 3 is either the refined expansion of level 2, where if level 2 is trending down, if level 1 is trending up, or level 2 is already broken and we're looking to confirm the pivot point of level 2 with our level 3 right here as the original example, okay? So I hope you guys understand that now a bit more clear, where we're looking at the structure from a characteristic standpoint, not from a specific time frame standpoint. because if we get rid of these overlaps right here and going back to the original roots, this could all take place on the same time frame. It has nothing to do with time frame, okay? This could be all on the 15-minute. It could all be on the 15-minute. It's just that level 1 is drawn from bottom to top, and level 2 is drawn from top to bottom, and level 3 is that refine of level 2 right there, also drawn from top to bottom in this case, because level 2 is a bullish breakup structure. This could all be on the same time frame. Now, it typically isn't the case, right? It isn't typically the case it's all on the same time frame, but it's simply that level 1 is drawn from low to high right there. Level 2 is drawn from high to low, and level 3 is also locally drawn from high to low after breaking level 2 back to bullish. That's what I want you to understand. It doesn't have to do anything particularly with high time frame, mid time frame, and low time frame. So, welcome to the introduction of the advanced TCT mentorship. But now, very important and very relevant, applying our 3 different levels of structure theory within Wyckoff models, the first variant. So, as you can see here, we have our initial range low, we have our initial range high, we have a deviation, creating a second tap, we're creating a nice good looking third tap POY, and price comes back down into that third tap, okay? Your level 1 market structure within the Wyckoff model is always going to be the market structure coming into your third tap, because that's what you're going to be looking at to confirm the Wyckoff model, and where you're going to be looking in this case of an accumulation for a bullish breakup structure. So that downtrend right there is always going to be your level 1 market structure that has your primary focus, okay? Now, it doesn't always have to start exactly from the highest point between tab 2 and tab 3 down towards that third tab low. It could also start from this point, for example. But just that structure coming into your third tap is going to be your level 1 that always has your focus, because that's what you're looking at to confirm the model. Now, understanding now the way that we're pulling 1, 2, and 3, there are going to be situations where you don't have that much conviction on the level 1 breaker structure right there. For example, if we have a market structure high there and we break it, but right above our market structure high is supply, you are vulnerable for getting a fake break into supply to then get still a move down back lower, okay? You don't know that at that specific point in time. So if the return to zone is not too good, which we'll be diving into in later lessons, and you have supply right above that market structure high, you always got to be a bit more skeptical. And in those situations, it is crucial to make use of your level 1, 2, and 3. So we can see right here, level 1 is coming into that POY, and we're having a structure break back to bullish. So level 1 is broken back to bullish. Therefore, level 1 can be drawn from bottom to top there and is going up, and therefore level 2 will be drawn from top to bottom, as you can see in red. And right here, we can see just an extreme demand POY located right there at the bottom of that third tap. So that's going to be our 1, broken back to bullish. Therefore, level 2 is always going to be drawn from top to bottom. And if level 2 breaks back to bullish, that will confirm the higher low for the higher high following that level 1 breaker structure. If we don't break level 2 back to bullish, then you're never going to be getting that higher low, and you're simply going to be trending down, taking out that low right there. Let's keep that in red. So waiting for level 2 will allow you to prevent on entering from a fake break. Level 3, if present, because it's not always present, but level 3, if present, is simply going to be, again, that refined structure of that most recent expansion on the level 2, right there, in blue. We can use that level 3 market structure high to confirm our potential entry back up to level 2, and then level 2 to level 1, and level 1 to the range high. It is important to understand that within that Wyckoff model, we can only use our level 3 breakup structure if there is no supply backing up your level 1 market structure high, okay? If there is supply, in case of an accumulation, backing up your level 2 market structure high, we cannot use level 3 as our entry confirmation. We have to wait for level 2. If there is nothing from a supply perspective and therefore from a resistance perspective in between level 3 and level 2, then you can already use level 3. And for that reason, we are also not going to be monitoring our level 2 and our level 1 market structure highs once we already confirm the model. If you can use your level 3 to confirm the higher low for the higher high, that is going to be also your entry confirmation within the Wyckoff model. I'm then not going to be looking to actively manage that position at each individual level market structure high. Okay, no. If the level 3 is present and can be used due to the fact that there's no resistance going to level 2, that is going to be your entry confirmation because you already have the breaker structure. However, at the initial break, you do not know if it's going to be a fake break or not. This right here is confirming the higher low for the higher high back up, and you're in a confirmed Wyckoff accumulation, and therefore that is going to be your entry confirmation with your invalidation below the low and your target the high. I'm not going to be actively looking at what's going to be happening at this level 2 market structure high in case we SFP it or in case we SFP it and break structure back to bearish. No. Same goes for this level 1 high. If we get the level 3 breaker structure right there, then that is going to be my entry confirmation because I'm only using the level 3 if I'm allowed to use the level 3, meaning there's no resistance between the level 3 high and the level 2 high. From a stop loss placement perspective, we can only put the stop loss below that local low, which confirms the higher low for the higher high following that initial breaker structure, if there's no demand remaining below that low and the actual third tab low of the Wyckoff. If there's still demand remaining below that low, we have to keep the stop loss below the original third tab. If we mitigate extreme demand, however, then there's no reason to go lower below that low again because there's nothing to hold price up in between this low and that low. So if you take that low, there's like a very high chance you're going to come to that third tab low, and therefore your invalidation moves up, and we can keep the stop loss below that local low. So this could also be used from a very refined entry perspective, because there are going to be situations where you do actually have conviction on that level 1 market structure break. Let's say you do have a nice return to zone coming into that high, there is no supply present, and you simply already enter on the level 1 breaker structure. Then you already enter right there, and you keep your stop loss below the third tab low, and then you simply target the high right there. However, if you're in that entry and you see something like this develop, then after that extreme demand mitigation and that bullish breaker structure, your invalidation changes from this low to that low, and therefore your stop loss amount is now de-risked partially, because previously you were risking, let's say, $100 on 8.5% stop loss. Now the stop loss becomes less, and your risk therefore also becomes less, maybe like back to $70 risk, and you can add that risk back on that breaker structure and get a more refined entry for a higher RR return. But it's simply important to understand that we can use the level 1, 2, and 3 showcased in here also within our Wyckoff model, where if level 1 gets broken back to bullish, but you do not have the confidence yet, you can wait for that level 2 breaker structure confirmation, and if level 3 is present and can be used, you can use level 3 as well. The second variant is going to be the more known variant, which is simply from a domino effect perspective, where we're coming down into that third tab POI, and we're simply observing the structure, and we can see that that black market structure right there, that's the main focus of our structure coming down into that third tab, and that's going to be your level 1 market structure high right there. And then we're simply searching if we can, on a lower time frame, potentially refine that structure back down into level 2 and level 3, and then see if we can use that level 3 to confirm already rotation back up to level 1 to get a more refined entry from that domino perspective, okay? From the domino effect perspective. So we're simply refining the most recent expansion of level 1 into level 2, and then refining the most recent expansion of level 2 into level 3, if possible. Again, the same rules apply from a resistance standpoint, that if there is supply backing up the level 2 high, we cannot use level 3. And then We're trying to get that earlier entry for the better risk to reward back up towards that range high. Okay? Whereas basically just the domino effect, as you guys know, but we're simply looking to get the most refined entry for the good looking target. Again here, once we confirm the entry on the level 3 break of structure, that means that we are allowed to use the level 3 break. That break already confirms the Wyckoff model, and I'm not looking to manage the position if we have a temporary SFP, for example, of level 2. No, this break of structure, if we are allowed to use it, which we're only allowed to use it if it's an easy rotation back up to level 2 and 1, that confirms my model. That's when I'm confirming the rotation back up to the high, and I'm simply having my entry right there with the stop loss below the low, target being the range high. Now, here I can also elaborate on the combination of level 1, 2, and 3 depending on what you are focusing on. Because let's say we have a bullish break of structure right here on the level 3, and we're seeing something like this develop right there. We're seeing something like this. Okay? We're seeing something like this develop. After that level 3 break of structure, we're seeing something like this develop. We have a retracement leg where the retracement leg has structure, and then the most recent expansion of the retracement leg also has more structure. Am I going to be using that from a level 1, 2, 3, 4, 5, and 6 perspective? No. If I'm zooming into this region, my initial previous level 3 break of structure, that becomes now my primary focus. So that becomes my level 1 right there. This becomes my level 1. Okay? And then that from top to bottom becomes my level 2. And then that most recent expansion, that retracement or that market structure in that most recent expansion of level 2 becomes my level 3 right there. So I'm always refining it back down to 1, 2, and 3. I'm not using 1, 2, 3, 4, 5, and 6. No. I'm using the previous 1, 2, and 3 from a context perspective, and then I'm zooming in, focusing here on my own 1, 2, and 3. So it's always going to be 1, 2, and 3, but then 1 is depending on what you are focusing on in the chart. Okay? Very important. And this will happen all the time, and you can get an even more refined entry, but we'll see that more in actual live trading examples. Okay? But just to highlight again that level 1 is going to be the structure depending on what the primary structure, depending on what you are going to be focusing on. So, lastly, I want to talk about the exception of the inside bar candle rule. So in the Mentorship 2024, I have talked about inside bar candles not counting in the pools of market structure where we're using the 6 candle rule. And I've stated that if your first candle's highs and lows are in between the second candle highs and lows, or the second candle highs and lows are in between the first candle highs and lows, that is going to be an inside bar candle, and it simply does not count as your market structure, or it does not take place as, it is not part of your 6 candle rule. Okay? However, an exception has been made of this rule. And that is regarding the first candle's highs and lows being in between your second candle highs and lows. So as you can see here, we have a bullish candle right there with a high and a low. And we can see that the second candle's high and low, we can see the second candle's low takes out the previous candle's low and then closes higher. Therefore, technically speaking, the first candle's highs and low are in between the second candle highs and low. However, I will be using this from a valid 6 candle rule perspective when we're in high probability environments. So let's say we're in a high probability TCT model, or just in a high probability model or environment as a whole, depending on the context, which we'll get more clear later, I will be using this as my structure. And the reason for this is because I'm viewing this second candle simply as a candle that swept the liquidity from the previous candle and still had bullish momentum afterwards, closing higher. And that is going to be very important because it needs to close higher. If it closes higher, I'm looking at this from the perspective of we swept the liquidity and got bullish momentum towards the upside. Therefore, I'll use this as a generalized uptrend. If we do not close higher and we take that low, this does not count as structure. You need to be trading higher, okay? And the exact same goes for when we're trending down. So when we're trending down and the second candle's high takes the previous candle high and trades lower, I'm viewing this as a liquidity sweep followed with bearish momentum towards the downside. And I'll use that as being part of the 6 candle rule. If the other 4 candles take part of the 6 candle rule, these are only 2 candles. But if we have an uptrend, a downtrend, and an uptrend, I'm using this as these 2 valid candles within that downtrend. If the second candle takes out the first candle's high but doesn't trade lower, it is invalidated. And this does not count as structure. You need to be trading lower, just like you need to be trading higher right here. Now, if the second candle high or low is within the first candle high and low, that's still an inside bar candle. The only exception is of the first candle. So if the first candle is in between the second candle highs and lows, when we're in a high probability environment, this will still be used as being part of the 6 candle rule, okay? Because I'm viewing this as a liquidity sweep followed by bullish momentum and a liquidity sweep followed with bearish momentum. So, guys, we got the exception of the inside bar candle rule. I've elaborated on how we're going to be using the level 1, 2, and 3 market structure within our Wyckoff models, and I've elaborated on the 2 core ways that I'm going to be using level 1, 2, and 3, which is from the perspective of level 1 trending up, level 2 trending down, level 3 being the refinement of level 2, or level 1 trending up, level 2 breaking also back to bullish, and therefore we're using level 3 as the pivot point confirmation for level 2. And obviously vice versa when we're trending down. And then level 1, 2, and 3, where level 1 is simply depending on what you are focusing on in the chart. And technically we have multiple levels of structure, but it's always going to be refined down and simplified back down to level 1, 2, and 3. That's going to be the theory. I'm going to see you all in the live examples. Peace out.